Our next guest, Garth Mackenzie. It's always nice to be joined by a fellow South African. Founder of Traders Corner, a trading analysis business which publishes both daily analysis and trade ideas for retail clients. He also runs an online high probability trading course. Garth also had his own TV show on South Africa's main business channel, Business Day. I used to watch it growing up as a youngster. His area of expertise lies in pure technicals with over 20 years of experience. So sit back and relax as Garth delivers playing by the book. It's all yours, Garth.
Thank you very much, Luke. Appreciate it. Thanks for the introduction. And yes, it's nice to not be the only South African in the room here. And my presentation will have a slightly South African element to it. I'm going to share my screen. So just confirm with me that you can see what I put up here. It's a PowerPoint presentation, and I just want to maximize it. I just want to check that you can see that, Luke, and we're all good to go.
Yeah, I can see that. That's
all
great.
Right. So thanks. I mean, you gave a great introduction to myself, Luke, so appreciate it. Yeah, I'm South African by origin. I've been trading the markets for over 20 years. I run my own trading business at traderscorner.co.za. I also run a high probability trading course, which is online, and you can access that from the website. And I also run a podcast called Talking with Traders, and that's where I interview traders each week. So I love trading. I'm passionate about it. It's been my life, my ambition right from when I was a teenager, and I absolutely love this business. Not that it is without its frustrations, and I've certainly got a lot of scars and war stories to tell of my time in the market. But I've been trading my own account, my own capital for the last 13 years exclusively. Before that, I was a retail broker in a futures broking firm in South Africa. And so my background was really as a futures broker. What I'm here to talk to you about today is trading plan and a playbook. So I know a couple of the other speakers have alluded to this here today, but I think it's very important as a trader that you have some sort of a playbook, some sort of a rule book, guidelines that dictates to you how you trade, when you trade, what you trade, because there's a whole world of instruments out there, and there are no rules in this business, really. There's nobody sitting on your shoulder, tapping you on the shoulder saying you should do this or you shouldn't do this. You almost need to be the creator of those rules, and you need to stick to those rules yourself. And to that extent, I think it's very important that you come up with a playbook for yourself, for your trading, that dictates how you're going to trade. So on this slide here, I've got a very basic background of how my trading plan looks, my playbook. This is sort of page 1 of it. It's actually quite a lengthy document, but essentially this is the summary page. So what I've done is broken the market down into effectively 4 different categories of market type environments that I look at. So the first is a rising trend environment. The next one is a sideways, choppy, range-bound kind of an environment. The third one is a downtrending environment. And then the last one is what I call special situations. Now, within each of these market environments, I then have different technical setups that I scan for. And this is not complicated stuff. If you've got any sort of basic technical analysis background, you'll probably recognize a lot of the setups that I refer to here. So I don't have time today to go through all of them, and there are actually 18 different trade setups that I look for when I'm scanning the market and scouring through my watch lists looking for trading opportunities. Of course, I don't have time to go through all 18 of those here today. So what I'm going to do is just go through the first 2, which are in actually rising trend environments, buy off an uptrend support, and then a bull flag. The rest of these are all available on my high probability trading course and I go into a great deal more detail about how each of them are derived and how you play them. But for me, this is a very useful exercise to do in terms of my own analysis each week and each day and how I'm looking for opportunities to trade the market. The last part of the slide down the bottom here is the risk component, and that is incredibly important, arguably the most important part of trading, I think. And it's where I basically say to myself, how much risk am I allowing myself to take on an individual trade? And you'll see that in all of these situations, no more than 0.75% of my capital will I be allowed to lose on an individual trade. And I can add to winners in certain setups. If the trade is working, I can add to that trade and add to it as it works. I'll never add to a loser. And I know it's been spoken about here already today, but that is a cardinal sin of trading. Don't add to your losers, because you don't want to make a problem even bigger. If your trade's not working out, well, then that's information that you should listen to. Only add to winning trades. All right, so I'm going to go through strategy number 1, which is buying off of an uptrend support. And I said to you that this presentation has a slightly South African element to it. So this is our currency, the South African rand versus the dollar. And it's been in a generally weakening trend since June of last year. In other words, the dollar is strengthening and the rand is weakening. And what you can see quite clearly here is that it has now recently pulled back to that uptrend support. This region around about 15 to 15 Rand 10 is quite a significant trend line support zone. And it also has a lateral support zone. That dotted line there actually indicates a number of previous swing highs over the last year. If I was to drag this chart further to the left, you would see what I mean. But in any case, what I'm really stressing here is that that is a critical zone of support where I would think that it is a logical region for this currency to probably stop strengthening. In other words, the rand stops strengthening and potentially starts to turn around and head in the direction of that prevailing trend again. That's the background thinking to it. But of course, once I've got that sort of line of thinking in my head, I then want to actually delve into this chart a little bit more closely and have a look at what's happening to it on the lower time frames. So the next thing I do is then drill in and have a look at the 1 hour chart. And I find that my execution chart is generally the 1 hour chart. So I'll do my bigger picture analysis on a daily chart like the one I just showed you, but this is now the 1 hour chart. And I'll then look for an indication that the market is starting to move in the right direction. So I said to you that on the daily chart, I'd identified a support area based on that longer term uptrend. You can see how the market seemed to hold that support level there, and it's begun to break down above this recent downward trend. So that break up above the downtrend and also above the moving averages here is what gives me the trigger for a buy signal. So the 2 moving averages that I'm looking at here are a 15 exponential moving average and a 30 exponential moving average. And these both are on the hourly chart, obviously. So once both of those moving averages have turned up and the price has broken up above both of those moving averages, that then gives me an indication that the market is doing what I think it should be doing if that support area is to hold, which it's done. So based on that, I'll then enter a trade. Now, this is where it gets more interesting, and I'm going to give you an example of how I would trade this with some assumptions. So assume I've got £100,000 worth of trading capital in an account. My risk, as I said, is always 0.75% maximum risk that I want to lose if I'm wrong. So that implies that I'm happy to, or not happy, but I'm willing to lose £750 if my trade and my analysis is incorrect. In this case, I was looking to buy, I did buy it at 15 Rand and 11 cents, and my stop loss is basically below the bottom of all of those lows of earlier this week, and that comes in at 15 Rand and 4 cents. So my risk here is 650 points effectively. If I'm spread trading this, then that's 650 points worth of risk on the currency itself. And to calculate my position size, I then take that £750 of risk and divide it by the 650 points. It gives me a number of £1.15 that I can risk on a trade here. My target is for a move up to 15 Rand 50. That's a minimum target. It could potentially go more than that, which means that my upside is 3,900 points. So in terms of a risk to reward ratio, if all goes according to plan here, then 650 points is what I'm willing to risk, and 3,900 points is what I can potentially make. And bringing that back to round numbers, it gives you a 1 to 6 risk reward ratio, which is very decent. And then, of course, if it gets to my target and I manage to achieve that 1 to 6 risk reward ratio, then the potential profit on offer here would be £4,485. So percentage-wise, that it translates into about 4.5% return on my £100,000 capital, which is a pretty decent return. If you stick a couple of those together and you string some of those together during the course of a year, then they add up, and they add up quite meaningfully. The real critical thing here is, though, stick to that stop loss and make sure that you don't lose more than what you set out to lose, which in this case was £750. So that's an example of buying off of uptrend support. The next strategy that I'm looking at here is buying a bull flag pattern. So a bull flag is a continuation pattern within a rising trend. And the thinking is that usually a bull flag will break out in the direction of the trend that it was going in before the price consolidated. So here we have a chart of the gold price currently. And what interests me here is the fact that it's recently broken up through this area of resistance at $1,830 an ounce. You can see the little bull flag pattern that is forming over there. You can see why it's called a flag, because it's kind of looks like a flag. There's your flag pole and there's your flag structure. And the thinking is that these patterns typically break out in the direction of the prevailing trend, and then you get a move towards your target, which in this case would be $1,880 an ounce for gold. Now, what I want to do next is look at an hourly chart. Again, I've done my bigger picture analysis on the daily chart. I'll now zoom in and look at it on the hourly chart to try and finesse an entry. So here what I'm looking at is, and it's actually interesting because I'm monitoring the gold price on another screen here, and it's kind of down at these lower levels at the moment where I'm watching for a potential trade setup. And this was not a trade recommendation, by the way. I was told beforehand for compliance purposes, don't be recommending any trades. So this is not a recommendation. I'm just telling you how I'm going to be doing it. And obviously you have your own rules and your own situation to deal with. So I'm not giving you advice here. I'm just showing you something that I've got in my mind at the moment. So here we have this hourly chart, and there's the flag pattern that I've pointed out already. What I'd be looking out for here is a pullback down into the bottom of this flag structure, and then a reversal up off the bottom of that area. That would be the aggressive entry. And if it does make a reversal there, then I would look to buy it with a stop loss down below the bottom of a reversal low. So, and then if it does recover and move up and start to break out the top of this flag pattern, well, then a break up above 1845 would actually validate the flag structure, and that would then give me reason to add to the trade. Now, in terms of a strategy here, I'm going to use the same sort of assumptions. So assuming £100,000 worth of capital, 0.75% risk is £750 that I'm willing to lose if this trade goes wrong. And let's make an assumption that it does make a reversal off to these lower levels right now where it is, and I managed to get in at 1,833 after a reversal has occurred. I'd set a stop loss below the reversal low, so let's just assume 1819 is a number. That means I'm risking 14 points effectively on the gold price. So I take my capital risk, which is £750, and I divide it by the points risk, which is 14 points, and that gives me a number of £53 per point. My target, as I said, is $1,880 an ounce. So the potential upside there would be 47 points. My risk to reward is 14 versus 47, which rounded down comes to 1 to 3.3 as a risk reward ratio. So the potential gain, if this all plays out according to how I would like to see it play out, is about £2,500. And obviously, if I'm wrong, I lose £750, and that's not the end of the world. It's the risk that I'm willing to assume on a trade. So those are two examples from my playbook, the types of technical analysis setups that I look for in trading. And following on from this, just in the last little bit, is just some basic trading principles to live by. And the first point is, well, a little goes a long way. And this is something I've learned over the years of trading, is trying to manage the greed, trying to not be too aggressive, manage the emotions. A little goes a long way. See the bigger picture. Think of your trading as like a test match, cricket match. It's not 20-20. You're not trying to smash sixes and fours off every ball. This is a game of inches, not a game of yards. So string those small trades, string the small winners together. Every now and again, you get a good one that makes you, you can take a bit of a leap forward. But the real key is to manage the risks and not to lose too much. Small positions are easier to run than big positions. This is something I've learned throughout my career, is that often if you put a position on that's too big, it might start to work for you. Maybe it doesn't, maybe it does. But in any case, it's difficult emotionally to run a big position. You're either going to snatch at a profit too quickly, or maybe cut a loss too quickly, or maybe, heaven forbid, not cut a loss because it's too painful. I've actually found in my career that I make more money out of small positions by being able to run them and having an emotionally calm state off of small positions rather than trading big positions. As I said, it's a game of inches, not a game of yards. Small risk with decent risk to reward ratios add up. As I said, I try and aim for a risk to reward ratio of 3, so 3 times more potential reward than what I'm likely to lose when I'm wrong. I know that I'm right only about 45% of the time with my trades. So if I'm making 3 times more on my winners than I'm losing on my losers, then I know that my edge is in my favor, and with that risk to reward ratio, I can make money over time. Compounding small gains is very powerful over time, and I'll show you an Excel spreadsheet with that just to illustrate that point in a moment. Sticking to a process is critical to stay on track. And I think to that point, your trading plan, your playbook has to dictate the type of process that you follow to trade. And it's really important. You've actually got to fall in love with your process, because I think that's really the key to trading success and to sticking to a process. Be patient. It's also a very important thing. Being a patient trader and waiting for the right setups makes you very powerful. And then last point, and this is a hat tip to Alpha Mind 101, which is Stephen Goldstein, who you heard on this webinar earlier. He is a brilliant coach. I've been doing a lot of work with Stephen Goldstein over the last year, and he has a saying: learn to love your losses. And I've just put in there, well, small losses. Learn to love your small losses. Small losses are part of this business, and you've got to accept that those are going to happen. Last thing from me is just a new share, and I want to show you this. This is an Excel spreadsheet. I presume you can see that there. So what is this? I call it my long-term consistency calculator. And it's always useful to just refer back to this thing every now and again to try and remind yourself of that bigger picture, thinking long-term. So the yellow blocks are the ones you can put in here as variables. So I'm going to just play around with it and show you. I look for about 100 trades per year. That's the number I'm trying to strive for based on the type of and the style of trader that I am. 100 trades per year is good. I know that my win rate is about 45% based on historical data. My average loser, I don't want it to ever be more than minus 0.75% of my capital. And my average winner, I'm aiming for 3 to 1, but I'm being conservative here. So if I can average a winner that's 2 times bigger than my losers, then that's a 1.5% capital gain.
Garth, and I'm starting with 5-minute heads up there quickly. Just wanted to let you know. Thanks.
Perfect. I'll be done well within that time, Luke. Thanks. If I assume starting capital of £100,000, like I've been using in the previous examples, then what do we get? Well, it means that out of 100 trades, 45 of them are winners, 55 are losers. The losers are all losing me 0.75% of my capital. The winners are all making me, on average, 1.5% of capital. So it comes out with an annualized return of 26%. Now, that might not sound incredibly sexy. I think it's pretty good. And I think experienced traders will know that that is actually quite a decent return. But this is where it really gets interesting. If you start looking at it in years, look 10 years out. You start with £100,000 and you grow that at 26% annually. You turn that into £1 million over 10 years. Let's just play with the numbers a little bit here. Let's say that instead of 1.5%, my average winner goes up to 2%. Suddenly that £1 million in 10 years is now sitting at 5.3 million pounds. This is this is very simple stuff. I mean, I know I'm making it look easy, and it's not easy. I'll accept that it's really not easy. But the point is, if you can get your mind into this way of thinking and know that it's a game of inches and manage your losses, and just inch forward, and you can achieve these types of returns, which are not outrageously unrealistic, in all honesty. You can make a lot of money by compounding your returns over time. So that's really the crux of the matter. That's it really from me, Luke. I think I'm in with a little bit of time to spare.
That was, yeah, you did. That was good, short, punchy, to the point, and many practical trade ideas. Love the trading, playing by the book and the framework that you use, and I'm sure clients got some extreme value from that. There's actually one question that's come in through afterwards, and it says, Garth, will you always wait for price to hit your target, or will you take some of it off if the trade is looking to reverse?
Yeah, it's a good question. So, I mean, I am a discretionary trader, so I'll watch the market action, and if it does look as if a trade is not gotten to the target yet, and it's starting to look a bit vulnerable, I may look to exit early. And that sometimes works for me, and sometimes that is to my detriment. But I think you do need to apply a little bit of flexibility in your trading. It's a great question, and what I always answer to that type of question is that knowing when to sell is the hardest part of trading. I find I can get an entry pretty well. I can use a stop loss, execute a stop loss in my sleep. But knowing the right time to sell is the hardest part of trading.
Completely agree. It's something I've definitely struggled with. Well, Garth, thank you so much, and really look forward to doing more work with you in the future after our Buy the Dip interview that we did. And this presentation has just been great. Once again, thank you so much. I really do appreciate you coming on.
Thank you.